Welcome, Desmond, and welcome everybody. So again here, most of this we're going to be doing rules and regulations common to all lines. These are very similar across most states. It's just that you're going to have a little discrepancy. So, we'll just go to the ones that are common to all states, and I'll point out some discrepancies that might exist. So, state regulations. For some states, the Commissioner of Insurance is appointed by the governor, while for other states, that commissioner is elected. I think you should pay attention to your state regulations to know if that commissioner is elected or if it's appointed. Most states, they are appointed. And for most states, they are appointed for the same term as the duration of time that the governor serves. So if the governor is a 2-year term, they are appointed for 2 years. And the person who regulates insurance in a state is, again, for some states, they call it the Commissioner of Insurance, and in other states, they call it the Director of Insurance. So pay attention to that. Those two terms, Commissioner of Insurance and Director of Insurance, you always see that in the exam. Also remember that they do not write laws. They do not write laws in the state. They basically enforce laws. They basically enforce laws. The laws are written by the state legislature. They are just responsible for enforcing those laws. And most of the enforcement that happens does not include jail time. Most of the enforcement that happens by the State Director of Insurance or the State Commissioner of Insurance does not include jail time. Remember, the State Commissioner of Insurance or the State Director of Insurance is the one who authorizes insurance companies to function in a state. And again, there are some terminologies that you'll see in the exam, terminologies such as what a domestic insurer is, what a foreign insurer is, and what an alien insurer is. You just have to remember that an insurance company that is incorporated in the state within which it operates is a domestic insurer. For example, for the state of Washington, if the insurance company is incorporated or registered in the state of Washington and operates or does business in the state of Washington, then that is a domestic insurer. An insurer that does business in another state, but is incorporated in another, for example, if an insurance does business in the state of Washington and is incorporated in the state of Delaware or in the state of Maryland or in the state of Pennsylvania, that is called a foreign insurer. That is called a foreign insurer. If it's an insurance company that is incorporated abroad in a different country, such as in Canada or in Switzerland, such as Zurich Insurance, that is from Switzerland, or Lloyd's of London, or Yasuda Fire from Japan, that insurance company is referred to as an alien insurer. So you'll see this in the exam setting. You'll see at least a few questions on this. Domestic, foreign, and alien. Remember, licenses may be issued only to individuals, and it's one license per agent, but you can hold different licenses for different lines of authority. You must be licensed with the authority with which you transact business. If you get insurance business and enter that policy through a company, for example, if you close on a policy with Transamerica or with Nationwide, and you enter that policy in a system when your license is not valid yet, even if you go get a valid license, that policy is not going to be valid. You will have to void it and then re-enter the policy. So having your license and having your license current is very important. If you enter that policy when your license had expired, you have to void that transaction and go enter it all over. You have to remember to avoid unfair trade practices, and those unfair trade practices include rebating, defamation, twisting, and there's rebating, there's defamation, there's twisting, and there's a third one there. So, there's a fourth one in there, So you have to remember to avoid those unfair trade practices. Companies that want to operate in a state obtain what we call a certificate of authority. You need a certificate of authority. And if you have a certificate of authority, then you're an authorized insurer. You're an authorized insurer. Sometimes they'll try to have you get confused between a certificate of authority and a certificate of insurance. Don't buy it. Certificate of authority is by an insurer to operate in a state. Certificate of insurance is something that a company offers to you when you have group insurance. So don't get confused. And don't get confused also between certificate of authority and a producer license. An insurance company does not get a license to operate in a state. They do not get a license to operate in a state. They get a certificate of authority to become an authorized insurer. Remember the concept of the State Guarantee Association? The State Guarantee Association. Remember that the State Guarantee Association exists in every state. Every state has a State Guarantee Association. And the State Guarantee Association exists to be able to protect clients, to be able to protect those who own insurance policies or annuities. If an insurance company is going insolvent or has financial difficulties and is unable to operate, what the State Guarantee Association does is it brings other or bigger or more stable insurance companies to buy out the insolvent insurer. So it's very difficult to see an insurance company go out of business because the State Guarantee Association will be there to rescue it. Insurance is really the backbone of an economy. It's wedded right in there with finance, and it is the backbone of an economy. It furnishes so much of what we do. It's an illegal practice for an insurance company or for a producer to go and try to use the existence of a State Guarantee Association as an advertisement point. You cannot go and say, oh, come and get some policies because we have a State Guarantee Association that's going to protect your policies if we go out of business. No, it's illegal. It's an illegal practice. Licensing requirements for all states that I've seen, you have to be 18 years and above. You have to be 18 years and above. You have to pass an examination, a licensing examination. You have to submit and pay your application fees. You have to be of good character. Pay attention to that. You have to be of good character. That's why when you register for a company like WFG, they'll run a background check. Remember that in the insurance business, there's a lot we do. There's a lot we do that relates to fiduciary responsibility. Fiduciary responsibility. And fiduciary responsibility comes about as your responsibility to handle matters involving money, fiscal matters. With fiduciary responsibility, you're seen as to operate with a capacity of trust, in a relationship of trust. So you have to be of good character. Very, very important. For some states, you have to pass a pre-licensing exam before you take the licensing exam. Some states, you have to pass that. But for most states, you don't have to. Even states like Washington that have it on their website that you have to take a pre-licensing exam, it's not necessary. I've registered for people. I've registered for the exam for people in the state of Washington that used to require a pre-licensing exam. They no longer do that. Even the state of Maryland, you had to go take the pre-licensing exam, pass it, download a certificate, and use that certificate to register for the licensing exam. No longer is that the case. The state of Maryland did away with that requirement. The types of licenses that you can have an individual license, that's an individual resident license, and an individual non-resident license. An individual resident license and an individual non-resident license. That's the great thing about this business. You know, you guys are getting into a phenomenal business. You have licenses, you have your license or you pass your exam in one state, and you can do business in all 50 states. You can do business in all 50 states just by getting a reciprocal license. And if you apply for those licenses in other states, usually within like 24 to 48 hours, you get approved. You get approved. So sometimes you apply and you get approved within like 2 to 6 hours, because some of those approvals are kind of very automatic in the system. You know, AI now, they verify if you're appointed in another state, everything checks out. You are not in any legal issue or in any legal trouble out there, they approve you. So a lot of those things are generated by AI. So very important. For most states, you have to renew those licenses within 2 years. Some states is 3, but for most states it's 2 years. You have to complete you have to do your continuing education course. For the state of Missouri, it's 16 hours. For the state of Kansas, it's 18 hours. For some states, like the state of Texas, it's a whopping 24 hours that you have to complete. You have to do continuing education, you know. You have to do continuing education. If you are in the business of insurance and you do not receive commission, you do not require a license. If you are just working as a secretary, taking calls, and you're not soliciting, you're not negotiating, you are not advocating, you don't need a license. But once you get to the position where you are soliciting and negotiating, you need a license. Once you're soliciting and you're negotiating, you need a license, you know. Disciplinary actions for most states will involve denial of your license, cease and desist order, suspension, revocation, and refusal to renew, and monetary fines, you know. So you just have to make sure that you stay within the good books of the state. You know, you don't do anything that runs afoul of the state regulations, you know. So state regulations are pretty heavy in the exam. They might be overlooked, but you overlook them at your own detriment. It's very important to go in there and read about those state regulations. All right. So let's do some questions here. Let's get in here and tangle with some questions. All right. And again, we're going to use a normal practice where we have somebody read as we move forward. So let's start with Tina. Tina, you want to read this one of 15? You want to read this one?
It's too small, please.
The font is too small?
Yes, for my eyes. I don't know.
All right.
Okay, that's good. That's good now. In order to conduct an examination of admitted insurance company in Missouri, the director may issue subpoenas only to employees of the Home Office, administer oaths to executive officers concerning financial matters, issue subpoenas and administer oaths to anyone on any matter that is relevant. Issue subpoenas only to any insurance company executive. So what is subpoenas? Is it a background check or what?
Subpoena is a legal term. It's like when they query you because you've done something wrong or you are alleged to have done something wrong. When they query you to provide a report or to appear someplace to answer for the wrong, that's a subpoena.
Well, why do they need it for somebody in order to conduct an examination of admitted insurance company? I don't know. This is not my state, so I don't know what
Correct.
to do there.
So in order to conduct an examination of an admitted insurance company in Missouri, the director may issue subpoena only to employees of the Home Office, administer oaths to executive officers concerning financial matters, issue subpoenas and administer oaths to anyone on any matter that is relevant, issue subpoenas only to an insurance company executive officer. Who wants to take a chance here?
I'm thinking.
I'm thinking D.
Okay.
I'm thinking D too, because responsibility and all of that. But at the same time, also B is also a possibility, but D is more.
Okay. Let's go with D and C. Oops.
I
It says
think
our answer is
C. Must
C.
be C.
Wow.
Administer oath to anyone.
Anyone on. Oh, that's interesting.
Yes, issue subpoenas and administer oaths to anyone on any matter that is relevant. Relevance is key.
Yeah.
Relevance is key. Very important.
Wow.
All right. Let's go to question 2 of 15. 2 of 15. Geraldine, you want to read this one?
Sure. A producer's license lasts for how many years before it needs to be renewed?
Okay.
2 years.
2 years.
2 years.
Yes. Yeah.
Again, for Missouri, it's 2 years. At Nebraska, I don't know if in Nebraska it's 3 years,
Washington is 2 years.
Okay. So, yeah, which is correct. Producer licenses are issued for periods of 2 years. All right. 3 of 15. 3 of 15. Olua, can you read this one?
It's Olua. When you call me Olua, you're calling me Lord.
Oh,
Listen, yeah, it's true.
okay.
Yeah.
So
So I'll read. What
All
must
right.
what must an insurance company that is organized in and has its home office in Missouri do in order to legally transact insurance in the state? A, nothing. They automatically qualify to transact insurance in the state. B, receive approval from the state legislature. C, obtain approval from the National Association of Insurance Companies. D, receive a certificate of authority from the director. I don't know if is this peculiar to just Missouri or
This one is general with all states.
But the name
I think
change.
it's D.
D.
Is it
Receive
D?
approval from the state legislator.
D.
B?
No, D from the director.
D from yeah, because there they call them director, right?
Yeah.
Correct.
D.
Correct.
So D is the answer.
Correct. They have to receive a certificate of authority from the director of insurance in the state.
Yes.
And remember that when you receive that certificate of authority, you become an authorized insurer.
Sure, yeah.
You become an authorized insurer. Also, just FYI to Lady Ibukon Nolua. Ibukon Nolua. I have to practice that and get it right. Ibukon Nolua. Remember, these licensing sessions are being taped. I don't know if you saw it. The links in the forum. I put it in the forum that Mark Cordelia created.
Yesterday.
Pardon?
I saw it yesterday.
All right, excellent. So, so great that you'll be able to access them. If I know you missed the class yesterday, so it's a good. I'm going to be putting that after this class this evening. I'll put it on that forum so you can access it. It was a good class for you to be able to go a review. You know, yeah. So also remember that regarding this certificate of authority, if an insurance company comes and its certificate of authority is not, say it runs afoul and it does not renew its certificate of authority or something, and it writes policies, those policies are not going to be discarded. Usually, they'll hold the insurance company responsible, but they are not going to discard those insurance policies because the state always militates towards the fact that if people have coverage, they want to keep those coverages effective, you know, unless the clients did something illegal to obtain those policies are always going to be respected. I see a lady who joined us from an iPhone. What's your name, if you don't mind me asking?
Good evening, Temi Tokpe.
Oh, Temi?
Yeah.
All right, Temi.
Yeah.
You guys have some very powerful names. We have Temi, who is like a global singer. We have Ibukon Olua, you know, who has a powerful name related to God Almighty. Now I see why this song goes, Olua na God, I know you always be thankful. If you no get here, better. So now I see where that song is coming from. So, all right, let's proceed. Yeah, they say all insurance companies must obtain a certificate of authority from the director before transacting business. Also, let me just give you guys a hint. When you see questions regarding authorization by the director of insurance or the commissioner of insurance in the state, you'll see they'll try to throw in the NAIC as if something happening in a state needs authorization from the NAIC. NAIC stands for National Association of Insurance Commissioners. National Association of Insurance Commissioners. Its duty is not to regulate insurance in a state, but the NAIC is a group where commissioners from all the states meet to review and advise on changes that might be needed in formulating insurance regulation. So it's a national association, it's a federal association. It does not regulate insurance in any state. So just remember that. So you're going to see them throw that in a lot of times, you know, or they're even going to throw it in to see if, or they can say, or associations that regulate variable policies, and you're going to see the NAIC as one that they throw in there. Remember, the NAIC does not regulate. Does not regulate. Let's, Temi, you want to read this one for us? Temi, you want to help us and read this one? Temi, are you there?
Yes, I'm here.
All right.
The question?
Yeah, you want to read the question that is on the screen?
Which of the following would be considered an illegal endorsement to purchase insurance?
Okay. Okay. You have to read the options also.
Oh, A confirming future dividend in a life insurance proposal.
Okay.
B, mailing an agency
Brochure.
broker to a prospective client.
Yes.
Listing the insurance companies the agency represents in a letter, and inviting prospective clients to the grand opening of the procedure's new office.
Okay. Yeah, thank you very much, Temi. So when we look at all of these, which of them seem to be an illegal inducement to purchase insurance?
Is A, confirming future dividends in a life insurance proposal.
Correct.
Because dividends
Correct.
are not guaranteed.
Very true. Dividends are definitely not guaranteed, you know. So that's true. There we go. So they say a participating life insurance policy may pay a portion of its net earnings to a policyholder, but dividends cannot be guaranteed, you know. So again, on this issue of dividends, remember, these companies that pay dividends are called participating life insurance companies. You might also see them referred to as mutual insurers, participating life insurance companies. And remember, the dividends they pay to the policyholders are an excess of premiums and revenues over expenses. So at the end of the year, the company will tally the premiums it has received and revenues and other revenues which it has received. When these revenues are in excess of the expenses of the company, that difference is paid back to policy owners as dividends. Also remember that on dividends, you do not pay taxes. On dividends, you do not pay taxes because they are not seen as income, but they are seen as a return of premiums. They are not seen as income, but they are seen as a return of premiums. However, if they pay these dividends into the accounts of the policyholders, and this money sits in those accounts and accumulates interest, that interest is taxable. It is seen as interest income. It is taxable. So dividends are not taxable, but interest is taxable. Remember that. 100% you're going to see that in the exam. 100%. Dividends are not taxable, but interest is taxable. So, all right, question 5 of 15 here. Elizabeth, can you read this one for us?
Which of the following will not be considered unfair discrimination by insurers? A, assigning different risk classifications to applicants based on gender identity. B, canceling individual coverage based on the insured marital status. C, discriminating on benefits coverages based on the insured habits and lifestyles. And D, charging applicants with similar health histories differently.
Okay. So again, which of the following will not be, thank you very much, Elizabeth, for reading that. Again, which of the following will not be considered unfair discrimination? Now, looking at those 4, which of those do we think will not be unfair discrimination?
C.
Discriminating in benefits and coverages based on the insurer's habit and lifestyle.
Correct. Yeah, smoking can be a habit. And if they do an investigative report and they come see that you stand on your front porch and you smoke 2 packs of cigarette every evening, they can charge you a higher premium for that. That would not be discrimination. So let's see if we're right. And that's correct. That is correct. Elizabeth, you want to read that explanation below?
Discriminating between individuals of the same class with equal life expectancies or by reason of race, nationality, or ethnic group will be considered unfair discrimination. Insurers are also not allowed to cancel individual coverage due to a change in marital status. Discriminating in benefits based on the insured habits and lifestyles, such as smoking or dangerous hobbies, is acceptable.
Yeah. Thank you very much.
I have a question, sir. Sorry about that. So does that mean that 2 individuals, let's say 2 men of equal age, habits and all of that, their premium will be kind of almost the same?
Yes. Yes.
Okay.
Because they quote you your premium based on a class,
Okay.
And if you fall within that class, so long as you guys are also of the same age, like you said, the most important factor they use in determining a person's premium is their attained age. And you'll see at least 5 questions in the exam that will test your knowledge on the fact that your attained age is a very important factor in determining your premium. You will see questions that will talk with premiums that are, or policies that are renewable, that have guaranteed renewability rider, which means you can renew them. They'll ask you, give you options. What is going to determine their premium at that time? Is it going to be the same? Is it going to increase? And if so, why? Remember, it's always about their attained age. Even for policies that have guaranteed insurability, which means if you want to get a policy at a later age, up to a certain upper limit, you can get the policy. They will try to test you on what is going to determine their premium at that time, and it is their attained age. So.
Thank you, sir.
You're welcome. Lola, can you read this one for us?
Whenever it appears that a producer or an insurer is violating the insurance law of Missouri, the director will do which of the following? A, report the person to the government. B, have the person arrested. C, levy a monetary fine. D, issue a cease and desist order. I think it's D.
Yeah.
D.
D.
Correct. Have the person arrested. The director of insurance does not have the power to arrest. That is purely something with the court system. So let's see if we're right. Okay. Yeah. You want to read that explanation?
Okay. Whenever it appears that any person is violating an insurance law, the director can issue a cease and desist order and schedule a hearing onto that matter.
Okay, that's good. Next question here, 7 of 15. Ms. Geraldine, can you read this one?
Yeah, sure. An agent offers their client free ticket to a sporting event in exchange for the purchase of an insurance policy. Assuming the tickets were not specified in the policy, the agent will be considered guilty of A, controlled business, B, coercion, C, rebating, and D, twisting. I think it's C.
All right. So very true. And rebating is defined as offering something of material value to induce somebody to buy a policy. In this case, free tickets to a sporting event, that is rebating, and that's an illegal practice. But it's very important for us to understand these other terminologies. Usually when I find a question, it's good to that has terminologies that might come in the exam. It's very good for us to understand what those terms mean. Starting with controlled business. What is controlled business? Controlled business is when an agent concentrates on writing policies only for their friends and their family members there. Only for their friends and family members there. So that is called controlled business. They might regulate that with a keener eye if they see that you're writing business that is mostly controlled business there. And that's why for most policies that we submit, whenever they ask you your relationship between you and the person, the default is always agent. You are the person's agent. So coercion. What is coercion? Coercion is using undue force or using duress to convince somebody to do something or to convince somebody to buy a policy. Coercion. coercion. So coercive practices are illegal. An example of coercion is if you go take a loan from a bank and they say you need an insurance policy to cover that loan, and that insurance policy, again, let me repeat that, is called credit life or decreasing term. If you go take a policy to cover a loan, it's called credit life or decreasing term. But if the bank tells you, we'll offer you that loan, but you have to buy that insurance policy only from us, that is coercion. It is not allowed. That is a coercive practice. It is not allowed. Twisting, what is twisting? Twisting is when you use deceptive information to convince somebody to switch from one policy to another. Twisting is when you use deceptive practices to convince somebody to switch from one policy to another. It's not allowed, you know. It is not allowed. And that's why for most policies, if you are rewriting a policy, you have to list the old policy that you're replacing. First of all, you have to identify if it's a replacement. You have to list the old policy, and you have to justify the basis for replacing that policy there. So, but as Ms. Geraldine said, offering something of material substance as an inducement to buy a policy is rebating, which is correct. Rebating, which is correct. We submit that, and that's true, you know.
So rebating is like what we call egunje or bribery?
Correct. That's bribery, very true. I'm sure every culture in Africa has its own terminology for egunje, you know, bribery. Where people are used to cutting corners, so yes, that is true. Yep. Next one. Lortosin. Can you read this one? Lortosin.
No, it's Oluwatosin.
Oluwatosin. Yeah. Well, our good friend from Georgia told me Oluwa means Lord, so Oluwatosin means Lortosin. So
it means God is worthy to be praised.
Oh, okay. I get it. Thank you. All right. Go ahead.
How many days does a producer have to report to the director any administrative action taken against the producer? A, 45 days, B, 10 days, C, 30 days, D, 15 days.
Okay. So this is a very valid question that you'll see in the exam, and it's very easy to miss it. I don't know what what it is. So whatever we choose here, we are going to learn. It's a foundation for us to learn. It might be a little different in other states, but I think it's going to be very similar. So any takers on how many days a producer has to report to the director any administrative action taken against the producer?
I can say 30 days.
Okay. Ms. Tina says 30 days. Let's see. So Tina, you think they will let you be writing policies if an administrative order has...
What is 15 days?
You think they will let you roam around for 30 days with a license that has an administrative...
Maybe it's 15 days. So I don't know. Now I'm confused with both of them.
Well, let's go with 30 and then we'll learn.
Okay.
She's correct. Is it?
Yeah.
She's correct. Tina was right.
I think I've come across it before. Yeah, I started this.
Right. Thank God I did not pressure you to, I did not change, you know, so.
That's coercion.
That's coercion. You have to stand your ground, Tina. When you put your foot and you say this is the answer, you stand your ground.
Answer, yeah, because these numbers sometimes they confuse me, but I know this is 30 days actually.
All right. So yeah. So it's an insurance producer must report to the director any administration action taken against a producer in another jurisdiction by another governmental agency in this state within 30 days of the final disposition of the matter. So, yeah. All right. Let's next one. Elizabeth, you want to read this one for us?
Within how many days are insurers required to notify the director that a producer's appointment has been terminated? A, 60 days, B, 15 days, C, 30 days, D, 10 days.
Okay. It's a similar but different question.
Mhm.
Any takers as to how many days here?
15 days, let's see.
Okay.
Leaning to 15.
All right. Let's see.
Uh-oh.
30 days again.
So 30 days.
So 30, 30. So 30, 30, 30, 30,
What's the
30,
question
30,
again?
30, 30. Let's go up to the question. Ms. Tina requests to see that question.
Yeah,
Let's
please,
go
I
up to
want
it.
to look at it again. So I will,
Let's go up to that question.
don't want to
So,
miss it.
within how many days are insurers required to notify the director that a producer's appointment has been terminated?
Oh, 30 days. Okay.
Yes.
No.
So you have to let the director of insurance know so that they can update their records.
Mhm.
Yeah. So, all right, let's go to the next one. Desmond, can you read this one?
A company has transacted insurance in the state without a certificate of authority. Which of the following is true of its obligation for the policy sold? A, the company cannot be sued in this state. B, the company's financial obligation will be transferred to the grantee association. C, the company is only liable for policies sold within the scope of the certificate of authority. D, can we see D? The company can still be liable for its policy in any court of this state.
Okay.
Let's look at that question again, please. Let's look at that
Let's look at the
question.
question.
Mhm.
If a company,
go ahead. No, you go ahead.
If a company has transacted insurance in this state without certificate of authority, which of the following is true of its obligation for the policy sold? I would have said
C.
C,
I'll say
yes.
C.
It's the B, yeah.
It's D.
I
Because
think
from the
Let's see.
explanation you gave us earlier on, you said
Oh,
that
C.
even if they are not
companies are
certified or
only
whatever, they are
liable.
still liable for any policy
Yes.
they issue.
They are.
Which is C.
C. That's D.
No, that's not so. C is saying it's only liable for within
This
the
is
scope
the
of
D.
certificate of
D.
authority.
The key to understanding and answering this question is this phrase here.
Obligation, yes.
True of its obligations.
Yes, that's D.
Sold.
So the answer is D.
Yeah.
Obligations is the key.
Okay.
Yeah. Obligations, it's key. Let's see if we're right.
Okay.
That's correct. Yeah.
The failure of a company transacting insurance business in this state to obtain a certificate of authority will not impair the validity of any act or contract of such company and will not prevent such company from defending any action in any court of this state. See how they connected that to one of the the answers given there too.
Correct. Yep. Yep. So they are still liable in the state of in the court of law, you know. So we're learning. 11 here. Tina, can you read this one?
Yes, so in insurance, Producers are permitted to share or split commission if both are properly licensed for the line of insurance. 2B, the insured knows and agrees to arrangement. C, there is a written agreement between the agent. D, the insurance department knows of the arrangement. So I'm going to take a
I'll go with A.
yes.
Hey,
A, yeah, A. If both of them are properly licensed.
All right, let's take a look. Let's take a look.
Yes.
That's correct. Yeah, so there does not need to be a written agreement. The insurance department does not need to know. They just need to be properly licensed in the line of authority, you know. So for a producer to receive commissions from the sale of insurance, they must be properly licensed in that line of insurance. All right. 12 of 15. 12 of 15. Our lady from Atlanta, Georgia, Ibokon Nolua. Can you read this one?
Yeah. All of the following are among the director's broad powers, except A, withdrawal or amend any rule or regulation. B, issue certificates of authority or suspend licenses. C, have interest in insurance companies regulated by the department. And D, regulate the internal affairs of the department.
Okay.
Except, having, I think D.
Okay, let's see, regulate the internal affairs of the department. That is close, but I would differ a little bit.
Okay, I'll take A.
All right, Tina goes with A. Is there any other suggestion?
Or C.
C. I said C.
C.
yes.
No,
He said except. He said
they say except.
Except.
Okay, so let's look at them one by one from D. Let's start from the bottom to see if those fall within the broad powers of the director of insurance. Okay, so regulate internal affairs of the department, certainly. Okay, let's go to C first. I mean B. B says issue certificates of authority or suspend licenses. Yes.
Yes.
So we've eliminated B and D. So the options are either going to be A and C.
Yes.
All right. Okay. C says have interest in insurance companies regulated by the department. A says withdraw or amend any rule or regulation.
No, he can't do that.
He can't do that. So
why is that, Desmond?
Yeah.
Why can't he do that?
Sorry, I
Because
didn't know my mic is still open.
he doesn't make.
Because it's not the director does not make rules or policies for the state. It's made by the legislator in the state.
Correct. The rules are made by the legislation. The director is an executive authority that executes those rules. So A could be the answer. But C says have interest in insurance companies regulated by the department. That is also what does interest mean? Does interest they mean have concern or care, pay attention, or do they mean have a share?
No.
So I think
does he get some profit from them?
They cannot have interest.
The interest is different. It's used in another way. Have interest in insurance companies regulated by the department. Yes.
Let's go with what. Go ahead, Tina.
A is the answer.
All right. Tina takes her stand in the United States. They have something they say the castle law. You defend yourself in your castle. So Tina is in a castle.
Myself because he doesn't like Brother Des said. He doesn't regulate it. He doesn't make the rules.
Correct.
He doesn't. mandate.
Let's submit and see. Oh.
Oh, why?
Wow.
So have interest in
Then
insurance
what
companies.
interest was it? He gave it up.
Yeah.
Yeah.
Interest.
Yeah. Have
Correct.
interest.
Mm-hmm.
Correct.
Oh.
So again, we came down to 2, and it just came down with our definition of the word interest.
Mm-hmm.
Hey. Oh,
So
I thought it's just
correct.
referred
So
to
by
use
interest,
interest.
they were talking about ownership interest.
Oh my gosh. That's why the word interest,
Yes. So the director may not have ownership of
Interesting.
But can
interest
he
in or
name?
any transactions in any capacity with any financial institution or insurance company licensed or regulated by the department except as a policy holder. So yes, but let's go back to that A, because
That
withdraw
again,
or
yes.
amend any
Can he
rule or
amend?
regulation. Well, Desmond, the reason why this might, again, this comes to a legal understanding, and let me say why this might be within the director's broad powers. Yes, insurance laws are promulgated and passed by the state legislature. But in law also, administrative agencies have the power to create laws. That's something we need to understand. Administrative agencies, for example, the EPA, the Environmental Protection Agency, has the power to create laws. And those laws stand, and it can enforce those laws unless those laws are challenged by the public or by consumers of that law, and they go to court and they say this law violates this constitution or this rule, and then they will strike down that law. So administrative agencies have the power to create laws. So A says withdraw or amend any rule or regulation. There is some truth to that. But when it comes down to the definition of interest, as we kind of toggled back and forth, if by interest they mean ownership interest, then that's something that they cannot do.
Okay.
So, but this has taught us and we have learned.
Yes.
All right. So let's go to 13 here. 13 here. Lola, can you read this one?
Is that me?
Yes.
Oh, okay, sorry. If an insurer meets the state financial requirements and is approved to transact business in the state, is considered to be A, authorized, B, qualified, C, approved, D, certified. I think it's authorized. They were also confused on
It's
the
authorized.
Yeah.
All right. You said A. We think you're right.
Yes.
Let's do that. So you want to read that explanation?
Insurers who meet the state financial requirements and are approved to transact business in that state are considered authorized or admitted into the state as a legal insurer.
All right. Very true. Very true. All right. Let's go to the next one here. Go to the next one. All right. Mr. Desmond, can you read this one?
Who is responsible for covering the expenses associated with the examination of a domestic insurer? A, the Department of Insurance. B, examined insurer. C, guaranteed association. Can we see D? D, the director.
Okay.
Who is responsible for covering the expenses associated with the examination of a domestic insurer? The examined insurer. B.
Okay.
B.
All right. Let's go with that and see. Let's go with that and see. And you're
Yeah.
correct.
Mhm.
I have thought in a previous session that the director of insurance would be responsible, but it is the examined insurer, you know.
Yeah, the director of insurance cannot come and pay another person's bill for what they did.
Yeah. My understanding is that they are examining them. They haven't found them to do something wrong. But again, as we know, if they are examining them, the insurance company will pay the cost of it. So it's
When you
all
go take a
reasonable.
test in the hospital, when you go take a test in the hospital, will the state pay for you?
That's a
Like,
very good way to put it, you know.
like
So
who is sitting for?
it's all reasonable expenses and charges associated with the examination must be paid by the examined insurer. Very good. Very good. Let's go to the next one. Ibukon Noloa, can you read this one?
Yes. Which of the following authorities may issue a cease and desist order if an insurer is violating the insurance code? The director, MIB, State Insurance Board, NAIC. I think it's the director.
Right.
Okay. Very true. Very true. Submit, and that's correct. So whenever it appears that any person is violating an insurance law of Missouri or any rule or regulation made by the director may issue a cease and desist order. And this applies to all states also, you know.
Yes.
It's a very uniform. So let's see how we did. Let's see how
Sorry
we
for
fared.
Done.
We pass.
We lost the 30.
And
So-
this was my confusion. The last question, because you know when we have read that director cannot withdraw any rule, because this question said that they make rule. You know, so that was, I think, was in number 13 or number 12 question.
Correct,
We were talking
correct.
about
Yeah.
Yeah.
So,
making the rule or
Correct.
something.
They always like to confuse us.
They always like to
Yeah.
confuse us because
Yeah.
if you read the subject matter, it will tell you that the state legislature is the one that makes laws, rules, and
Yes.
regulations.
Mhm.
But if you use a legal backdrop, you'll see that administrative agencies have the power to make laws. You know, so that's kind of
Is it almost like an executive order or kind of something? Let's say
yeah.
something.
It's an executive order. Yes.
Mhm.
Okay.
Yes, because administrative authorities take their power from the executive,
Mhm.
you know. And so, yes, they have the power to make some laws. For example, the EPA, like I said, has the power to make laws regarding environmental protection, you know. However, these laws can be easily challenged by companies. And that's why we have the court system. The court system is going to be the final arbiter to see if those laws meet constitutional muster or constitutional test or not.
Mhm.
So
So,
I know
okay, go ahead. Sorry about that.
No, you go ahead. Go ahead.
Okay, thank you. I was going to say that, you know, when I was reading this, my understanding of the director is, you know, like when we have the central bank director,
Mm-hmm.
that they kind of just regulate the insurance business. That was my understanding. But I do have a question.
Correct.
You know, so if we are writing this exam now, it's 150 questions. So as you answer the questions, do you see which one you get right, which one you didn't get right, or it's at the end of the exam? Or how does that
No.
work?
When you're doing the exam, you don't see them as you go. You answer all of them. You hit submit at the end, and it will tell you if you passed or failed.
So you won't see if the ones you got right or the ones
Correct.
you failed.
Correct.
Okay.
Yeah. So
Okay.
I knew our intention was to do just one chapter, but we started early at 7. So if you guys can hang on for just about 45 minutes, we're going to do another chapter here. You know.
Wow, thank you.
Yes. I am getting a little warmed up, and I don't want to quit right now. So let me give my teacup for my daughter to go heat up my tea.
I told you, say you had something at 8 p.m.
Yeah, I have a production class, but I'm going to this class is very important. So We will.
Yes.
Well, I'll go late to the production. Somebody is already starting to teach the production class. I'll join it late, you know.
Thank you.
And that's the great
Thank
thing
you,
about
Pat.
you guys being in this team. We are very well structured. We have, like, as you guys see, we have licensing classes going on. There are many people who are coming on who are going to be helping to teach these licensing classes. As you see, we are preparing videos where when you guys recruit people, you can put the video, you can send the videos to them. They can start watching these videos and understanding the material. And may I also say these videos, the class is being taught by a lawyer. So that gives you an added plus to go recruit people and say, hey, we got very competent people teaching
Yes.
this class, you know.
That's right.
So it's an instrument in your hands. And then we have very robust production training classes where they train you on the vendors, we will train you on the policies, they train you on how to recruit, how to present, and all of that. So just hurry and get your license. You are in a good place. You'll be able to soar really, really well in this structure that we have set up here, you know.
Thank you.
So let's go ahead and see if we can do this chapter here. Let me see if I want to see if I can go to, if you allow me, go to the summary recap.
Yeah.
Let me see. Yeah, let's do chapter recap here. Chapter recap. So there we go. Let's see. All right. Chapter recap. Here we are. Here we are. So here we are. Policy replacement, you know. And again, as you guys have seen, the state is very keen when it talks about policies that are being replaced. When you want to replace a policy, even if you're writing a new policy, they will ask you if that client that you're writing that policy for has any policy that has lapsed, been forfeited, surrendered, or terminated within probably the last 1 year or the last 5 years. So, or reissued with a reduction in case value, or converted to a reduced paid up insurance. They want to know all of that information. You know, in America, they like to gather data. They like to gather data. And one thing that they also are very leery of, they don't want people going and convincing older people to replace their policies so that they can make a higher premium on it, you know. So they are very keen on that. So there's a notice regarding replacement that is provided by the agent to the client, to the prospective client. They sign that when they are signing their application, you know. So again, for individual policy provisions, the highest interest that you can charge on a policy, say if you take a policy loan, because there are policies that accumulate loans. Again, the policies that accumulate cash are universal life policies and whole life policies. So you'll see index universal life, you'll see variable universal life, but just remember that those policies that accumulate cash are universal life policies or universal or whole life policies there. Remember, if you see the word term, every time you see the word term in the exam, take away cash. Term, just know it's limited duration, no cash. Limited duration, no cash, and it's cheaper also. It's cheaper, you know. But again, term is not always good. We don't advise for term. I have this quote that says, I have this quote that says, the bitterness of low quality remains long after the sweetness of low price is gone. So the bitterness of low quality remains long after the sweetness of low price is gone. You get a term policy, it's going to last only for a limited duration of time. And these insurance companies know it. If you go to quote somebody a term, and let's say they are 58 years old, they will not have a 30-year-old term. They can only give you a quote for a 25-year term. Why? Because they want to make sure you outlive your policy. If you go if you are like 63 years old, around that, they will not give you a quote for a 25-year term. Yeah. Now they'll give you a quote only for a 20-year term. because they know there are chances you're going to outlive that policy. And you're going to pay all of those premiums and not collect anything. So, yeah. If you get to be like 68, 69, they will not give you a 20-year term. They'll quote you a 15-year term. So be mindful of that. Universal life, especially for us from the African community, because we have so many social things that require expenditures from us. We have so many social commitments, and that also means we don't get to save a lot. So having a whole life policy or universal life policy, especially an indexed universal life policy, is one of the best ways to discipline yourself and put yourself in a position to save. You would be surprised. People will call from home, they will have some issue, they'll whip up some emotional story. Again, all of us send money at home, and a lot of those requests are legitimate. But sometimes we think that we can rescue everybody. But they say when you are in an airplane and there's turbulence and it's going down, who do they say you should put whose face mask should you put on first? You or the person besides you?
Yourself.
Yes.
Yourself.
Your own, you know.
Even when you have a baby, you put yours first before your child.
Correct. So we need these instruments to help us protect ourselves first, then we can help others with whatever is left. So accelerated benefits. Remember, accelerated benefits is these companies or these policies paying you ahead of time from your death benefit. Is this company paying you ahead of time from the death benefit that you have? So accelerated benefits are the payments of your death benefit ahead of time. They'll pay you ahead of time for critical illness, for chronic illness, for long-term care. And trust me, when you get to the stage where you need these policies, you really need them. They will help you, they will help bring down your stress, monetary and financial stress. So these policies are very important. Even for some of us who are young, who have parents, hello, insure your parents. Insure your parents. And for some of you guys, parents who are already in your 60s, encourage your kids to cover you. They can be the owner of the policies. Some people are so worried about death. Everybody's going to die. Don't die for free. Everybody's going to die. Don't die for free. Because when our parents get sick, guess who becomes responsible? Us. We Africans like to take care of our parents.
Mr. Valentine, can I ask a question?
Go ahead.
Why are these policies so expensive for older folk?
They are relatively expensive for older folks because your longevity of life is shorter.
Who says we're dying tomorrow?
Well, it's not that you're dying tomorrow, but your longevity of life is shorter. It's science. But you will never pay the insurance companies as much money as they'll pay you. Okay? You will never pay the insurance companies as much money as they'll pay you. I have an aunt in Chicago. Okay? I educated the kids to get a policy for their mom. They got a policy for their mom. 2001. Okay, they got a policy for their mom. They thought it was too expensive. It was a $250,000 policy, but the premium was $1,018 a month, which they wanted to because they had lost another aunt and they had to bear all the costs. It cost about $45,000 just to send the cops home. So they wanted to have their mom covered. So they thought $1,018 was too expensive for the policy, but they got it because the kids all band together and they paid the premium. Because they know that if anything is wrong with their mom, they are the ones responsible. Well, last August, the mom was diagnosed with stage 4 colon cancer. That policy's cash value has bailed that policy now to, it's no longer $250,000, it's $295,000. So who is now taking care of that mother? Those kids. But that money can come to help with education for their own kids. Now they can spend happily to take care of their mother, knowing that even if they don't use the critical and chronic illness benefits, they know that something is going to stay with the family. It's called legacy transfer. Transferring money tax-free to the next generation. So these policies, we might think they are expensive, but trust me, when you get into that situation of critical, chronic, or terminal illness, you're going to wish you had a policy. You're going to be asking, why didn't I do it? You know, so very important for us parents. Let's not be afraid of death. Death is going to come whether we're afraid of it or not, you know. But what legacy do we leave behind? You know, and how do we put the next generation on a better footing? Miss Geraldine is my friend here. She lives with me here in Kansas City. I got out of undergraduate school in 1995. I always wanted to go to law school. I took the entrance exam into law school 6 times before I got into law school. And the reason why I kept taking it and could not go to law school was that I had my younger sisters in Africa, and all of them were still in secondary, high school, and university. If I go to law school, I cannot work. And so they are going to fall between the cracks. I lost my dad when I was 27. So I was the one basically responsible for paying their fees. How can I sacrifice them to pursue my own goals? I couldn't.
And Mike is the only boy, the only son.
Yeah, Geraldine knows I'm the only son. And so what if my father had a policy? What if he had left a legacy? Would I then have needed to sacrifice going to law school at an earlier age? I could have gone to law school at age 27, and I could have been established somewhere, someplace in the legal field. But Geraldine knows I had to wait and go to law school at age 45 because I had to wait and put all of my sisters through college and university.
You are an African.
Thank you.
And this is why we carry so much burden. Even at this very old age, people are still looking for me to train their children.
Correct. But the more legacies we leave for our own children, the lesser they will have to. The earlier will need to rely, or even if we rely on them, they will have a strong legacy to continue. I'm gonna give you guys 2 examples here. Sorry that I'm digressing, but I really want to educate. This thing is a passion for me because I was a brilliant law student even at age 45. But by the time I graduated from law school and took the bar at 48, 49, I was too tired. In fact, law school was so intense that going to law school at 8:45, I went into law school very healthy and everything. I came out with diabetes.
I know what you mean. The pressure is too much, bro.
The pressure is so hard. I could not even eat lunch. I could not eat dinner. I would just take fruits and eat fruits because you have to be studying in the library until 12 midnight. Geraldine knows that very well. Yeah. And so, but let me give you guys some examples. Bill Gates. That's why this thing is a passion for me, because the instruments we are going to leave behind are going to help change Africa. I believe that this business is a godsend. Bill Gates was admitted into Harvard, spent just about a year, quit. Says Harvard was not teaching him what he needed to know. Left from Harvard, went to his parents, and was staying in their home, tinkering with computer software. Guess what? He ended up inventing a software called DOS, D-O-S. DOS stands for Disk Operating System.
No. It has been, DOS has been there. He put graphics into it.
No. He did it well. You're right. He did not invent DOS. He bought DOS from somebody. You're very right. He bought DOS from somebody, changed a few things with DOS. He owned DOS. He bought it, changed a few things with DOS, and then IBM at that time was transitioning from making mainframe computers that occupy like one big room into making personal desktop computers.
Mhm.
They did not have software. They were looking for bits for software to run desktop computers. So they asked people to submit bits. Bill Gates submitted DOS. DOS won the bid. IBM wanted to buy DOS outright from Bill Gates. He said, no, I will not sell you my computer. I will license it to you guys. Instead of buying my computer outright for $50,000, remember $50,000 in the late 70s was a lot of money. He said, no, I'm not going to sell it. I'm going to license it. So he says, for every computer, I'll be happy to make $1. That's fine. Again, he wasn't desperate because the parents had legacy. They had money. There was money in the family. These things we do are very important, guys. Remember the two brothers? One sold his birthright for what? A bowl of porridge.
Porridge.
IBM's own expectations then was that forever and ever, for the life of computers, maybe they would manufacture and sell 100,000 computers. Guys, listen to that. That was IBM's estimation, that if they were fortunate in selling so many computers, they were going to sell just 100,000 computers forever and ever. That's why they call them International Business Machines. IBM stands for International Business Machines, because they didn't know that they were going to be selling billions and billions of computers. Bill Gates licensed it. In a few short years, IBM was selling hundreds of millions of computers. Bill Gates became an instant billionaire. As Desmond said, he went and bought he first went and got the tree folder structure, because those used to be a set of commands, and put it in there. So you had the tree folders where you go to D, you expand the folder, you go to the subfolders. He took that and added it from Unix. And then he added the Windows structure onto it, as Desmond said. Now we had Windows 3.1, Windows 95, Windows 98, Windows Millennium, Windows XP. Then he added the operating system, Windows NT, Windows Server, and now we have Active Directory. Now we're having ChatGPT. Guys, worth now over $150 billion. Why? Because the family had legacy. So these things that we're doing, writing policies and handing over legacies to families, we might think that we're just writing people policies, but your own grandchild might be the one who has that idea, who can build their own chain of Marriott hotels in Africa. And because a legacy was left, it's going to make a difference. The same thing with Bill Gates, same thing with Mark Zuckerberg, same thing with Larry Ellison of Oracle. All of them are first-generation trillion-dollar companies because they were able to take a risk in their life between the ages of 19 and 29. Let me not digress too much. Let me get back to what we're doing. But I just wanted to tell you guys why I'm so passionate about this and why I think that these instruments are going to end up making a huge difference in our community. All right. Again, we're saying accelerated benefits. Again, they pay you in advance for your death benefit. And sometimes you might have a whole life or universal life policy, maybe $1 million policy is grown out to about $1.7 million. If you have a situation that you need to be covered for critical illness, they will pay you 90% of that, which is $900,000. That's a lot. Can change the life of a lot of families. Assignability is when you take a policy and you can transfer the rights of ownership. You own a policy and you can transfer the rights of ownership. Little digression. Disney. See that company, Disney? Multi-$100 billion company. Disney, the grandfather of Disney was drawing cartoons. He bought a universal life policy around 1916. In the late 20s, there was the Great Depression. He wanted to move from basically drawing cartoons to making animation. He did not have the capital. 1929, there was the Great Depression. No bank was willing to lend money to anybody. He went to the bank. The bank said, what can we have for collateral? He had a universal life policy. The bank said, yes, it has cash value, it has policy value, we'll take it, we'll hold it, and we'll loan you funds. From then, he started his animations. Now everybody in the world knows about Mickey Mouse. The power of these instruments. If you have a policy, especially a policy that you've been paying for a long time, has accumulated cash, that policy has enough value where you can take it to the bank, put it as collateral, and take a loan. Very, very important. These instruments are powerful.
Education.
Exclusions. Thank you, Tina.
No,
Exclusions.
I said the education is very important. I'm just regretting all the opportunities I missed.
No, you didn't miss them.
I'm old now. I'm not young anymore, so I don't know how much I can do.
Sister Tina, God's time is the best.
God's time is the best.
Let me just say one thing. Is what do you call it? KFC. The owner of KFC did not start KFC. It was until he was in his 60s, like 60 or 65. So remember that.
Yes, I'm at that stage now.
We are getting knowledge, and the future for us as a people is very bright. I believe that in every fiber of my body. Remember, when our countries, African countries, got independence in the 60s, less than 1% of Africa had a college education.
Yes.
Right now, over 25% of every African country has college education. Yes. We are getting knowledge, we are getting education. The difference is going to be massive. All right. So exclusions, suicide. Usually for most states, if you commit suicide within a year, it's not covered. Within a year, it's not covered. War and aviation, usually most policies have that exclusion clause that if you die as a cause of war, it is not covered. It is not covered. I don't know if they're going to have it here. Remember also hazardous occupations. Hazardous occupations. So if you write a policy, because they'll ask you your occupation, you know. If you write a policy and say you said you were a school teacher, and then they write you have $1 million policy, and then 6 months after writing that policy, you switch and you become a mine worker. So you're working in a mine, which is a hazardous occupation. Well, if you pass away and they realize that you were working for a mine, they will reduce your face value to what it would have been for that premium had they known that you were going to be working in a mine. So hazardous occupations are relevant. You will see this in the exam. They will ask questions regarding that. Remember that it is always the adjustment of your face value. Group policy provisions. Group policy provisions. Certificate of insurance. Remember, if you're working in a company and you have certificate of insurance, they have to be delivered to each employee. You don't own the policy, you own just a certificate of insurance. But again, when you lose that job, you lose the policy. Entire contract. They always ask this question with the proposition of if you understand that a copy of the application is part of the entire contract. Usually when you start writing policies and you write a policy for a client, and you write a policy for a client, and you want to deliver the policy documents or the policy booklet, it always has a copy of the application in there. So the copy of the application is always part of that contract. Evidence of insurability. Again, for most group policies, they may require evidence of insurability, but usually they do not. Because group policies, their premiums are usually calculated just based on the average age of men to women, or the ratio of men to women within that group and the average age. But when you leave that company and you want to switch from that policy, because you have about 31 days when you leave from that job to switch from that policy to another one, remember that you have to switch to a permanent policy. So it's not going to be term. You have to switch to a permanent policy, but you do not need evidence of insurability. Also remember that during that period of switch, that 31 days, if anything happens and you pass away, your policy is effective and you're covered. When they ask you that question in the exam, they might try to trick you to see if you understand that you get paid your entire death benefit and they will not deduct the premium for that month. So though you left that company, you did not pay your co-pay for the policy, something happens to you and you pass away, your policy is still within grace period and they will not deduct any premiums from the total death benefit. Remember that. Grace period is usually 31 days across all states for group policies. And here they're also talking about the concept of incontestability, which is 2 years. Contestability is that 2-year period when you write a policy again, if you misstated something on the application that was material, if the insurance company catches it within those 2 years, they can rewrite that policy, they can cancel it and return your premiums. But after 2 years, even if you intentionally misstated something and they catch it after 2 years, they cannot cancel or rewrite that policy. It's gotten into the incontestable period. But there's one exception: misstatement of age or gender. Misstatement of age or gender, but mostly misstatement of age. If you misstate your age, say you were 65 and you said you were 54, they can rewrite that policy to what it would have been with your right age. They can rewrite that policy. Representations. Remember, statements you make on an application are not considered warranties. Statements you make on an application are not considered warranties. They are called representations. And what's the difference? Warranties are what you know for a fact to be true. Representations is what you know to be true to the best of your knowledge. That's the difference. Warranties, you know for a fact to be true. Representations, you know to be true to the best of your knowledge. What is an example of a representation? They say, how much do you weigh? You say 175. You didn't just weigh yourself 2 minutes ago. You might have weighed yourself when you went to the doctor's office 2 months ago and you were 175. You might have eaten some egba intensely over the past month and you might have put some good 7 pounds. So you might be about 182 now. But it's a representation that you are 175. So warranties versus representations. Credit insurance. Remember, this will come in the exam. It will be plentiful over the exam like white on rice. Credit insurance. What is another term? What is another description for credit insurance? Decreasing term. Decreasing term. Remember, with decreasing term, it is not the premium that is decreasing. What is decreasing in decreasing term?
The face amount.
The face value. And what is decreasing term? Decreasing term is when you go to the bank to take a loan, and the bank says, we need an insurance policy to cover you. We need an insurance policy to cover you in case you die and we cannot get our money for that loan. They give you $1 million loan. They say, we need a policy on your head for $1 million. Guess what? Decreasing term. Decreasing term. Why is it decreasing? Because if you go take a loan from the bank, let's take a loan that most of us have taken, a mortgage loan. As you pay that mortgage, part of the money goes towards interest and part of it goes towards the principal. So the outstanding balance of that mortgage is always decreasing. Now, if the outstanding balance is decreasing, it also means that the amount of insurance needed to cover that policy is decreasing also. So in a decreasing term, the face value is always decreasing, but again, the premium stays equal. When you're close to paying off that loan, the death benefit of that policy is also close to being zero. And when the death benefit is paid off, the face value is zero as well. Remember that with decreasing term, which is credit life insurance, the bank is the owner, or the creditor. Let me take out the bank. The creditor, which might be a bank, might be a financial company, the creditor is the owner of the policy. The debtor is the insured, and the creditor is the beneficiary. Creditor is the owner and the beneficiary. The debtor is the insured and the payer of the policy. Decreasing term. And remember also that there is insurable interest between the creditor and the debtor. There is insurable interest. You'll see that term insurable interest all through the exam. And what is insurable interest? It is the familial relationship that somebody has that gives them that right to insure another, a third party. The familial relationship. What are some examples of insurable interest? Again, creditor and debtor, mother and child, child and mother, spouses have insurable interest in each other. Business partners in a company also have insurable interest in each other. Employers have insurable interest in their employees. So remember that term, insurable interest. It exists between a creditor and the debtor in credit insurance. So creditor is the owner and the beneficiary, and is usually a decreasing term. Okay? Amount of coverage cannot exceed the amount of the debt. Evidence of insurability or evidence of insurance, the same must be provided to the debtor insured within 30 days after the insurance term begins. So, other life insurance regulations. Other life insurance regulations. Variable products. Company must be appropriately licensed and have capital and surplus. Let me switch my screen to see that term appropriately, and surplus of at least $2.5 million. So they must have capital or surplus of at least $2.5 million to be able to issue variable insurance. I remember way back in 1994, my uncle used to own a construction company in Lincoln, Nebraska, where our good Oluwatosin lives. We needed to take a loan from the bank. We went to a bank in Ashland, Nebraska. Their capital is in Omaha. And we wanted to take a loan. I think that loan was about $1.2 million. The owner of that loan, Mr. Lee Sapp, who owns Lee Sapp Petroleum, Oluwa, you probably know of those petroleum stations across Nebraska, Colorado, Kansas, Lee Sapp. He made sure he got an insurance policy on my uncle's life to make sure that if that loan wasn't paid and my uncle passed away, they could collect. So made sure that he made sure that he had a $1.2 million on my uncle's life. So they don't play. Banks don't play. Creditors do not play.
Yeah, it's funny.
Variable products. Policies must comply with state regulations. There are suitability standards, and they must issue annual reports to policyholders. So remember, those reports must be issued to policyholders at least once a year. At least once a year. Remember that to be able to write variable products, you need not just a producer license like we are starting to get, you also need a securities license. 1000% you will see that question in the exam. You need a securities license, and you need to be registered with an organization called FINRA. FINRA is an organization that regulates securities license. So you need to be able to write a policy, a variable policy, you need a producer license, you need a securities license, and you need to be registered with FINRA. They're going to throw a trick in there to see if you might think that they need to be regulated by the SEC, the Securities and Exchange Commission. Remember, no, a big fat no. SEC only regulates companies that issue public stock. They don't regulate licenses. They don't regulate securities licenses. All right. Universal Life. They say periodic disclosure to policyholders, annual reports with current illustration, policy guarantees, minimum interest rate and maximum mortality and expense charges, description of calculation of cash surrender values. A universal life policy is one of the best means for you to have a legacy transfer in your family. One of the best. It is guaranteed if you just keep your policy active. Very, very guaranteed. And Black families are the least with legacy transfers. So we need to up that average. Graded death benefits. Again, if I had to run a quick illustration here, I'll be able to show a lot of these benefits here. Graded death benefits used for substandard risk, little or no underwriting, benefit increases over time, guaranteed, which means they are guaranteed on their issue basis, must comply with age restrictions for grading the death benefit. So these are just some little nuances that go into what we call graded benefits, which means there's a good balance. Since it's a universal life policy, there's a minimum starting death benefit. As that policy builds cash, the death benefit also increases. That process of increasing, one of those processes is called graded. And you can borrow cash from the policy, you can make withdrawals, and if you pass away, they pay you both that guaranteed initial death benefit called the face amount, plus any growth in cash. Plus any growth in cash. All right. I'm gonna run, they are talking about certain things here which we might need a quick illustration. So I'm just gonna run a quick illustration just to make sure that if I need to refer to it to drive some matters home. And they're gonna teach you guys how to do this when you all get your licenses, but I'm gonna go into Transamerica's system, just run a quick illustration. It's gonna take me just 2 minutes to do it. So, so just give me a minute. Launch Illustrator. Let's say we're doing it for the state of Washington. Yeah. State of Washington. Name. Moshood Abiola. All right. Let's say he was 35 years old. He's male. We give him preferred elite. We want to, let's leave it GPT. You see graded here. We're talking about graded. So it's one of the means of how the death benefit option increases. So we choose graded. Let's give him a $1 million policy, or let's give him a $1.5 million policy here. Let's plan periodic premiums target. Let's put their money in the balance on cap. This is a great deal going on. If you have a policy, we throw all your money in there and it grows above the cap. You know, you guys are going to learn this after you get your license. So we don't worry about distribution at this point. We give them those riders. Remember those riders we talked about, those accelerated death benefits. So we give them critical illness and we give them long-term care. So we run it to see what their premium is at age 35. Let's go to their cover page here. All right. So again, Moshood Abiola, I'm sure he could have been able to afford this very easily when he was alive, before he got killed by the military. So 1.5 million, premium 1,275. That was a travesty for Nigeria. Great businessman, Moshood Abiola.
Yeah.
Was it Babangida or Sani Abacha that killed him?
He died in prison, so we can't really say who killed him.
Well, we can't say alleged. As a lawyer, let me use the word alleged. Alleged
Well,
to have killed him.
Yeah, okay, yeah. That should be
Yes. But who was the president at that time? Was it Babangida or Sani Abacha?
Sani Abacha.
I think it was Sani Abacha. Yes.
Yeah.
Abacha was a character. Yeah. So premium 1,278. Now you see, for a 35-year-old, for a $1.5 million policy, and this is not a policy, guys. This is an investment. If anybody tells you that this is a policy, tell them lie. It's one of the best investments you'll ever see. Their cash in it grows at about 12.14% a year. All the policies I have for last year, they grew by over 12%. It's not a policy, it's an investment. It's just masquerading, it's just disguising itself as an insurance policy to qualify for a lot of tax benefits. So it's Oyibo sense to put their money in places, you know, like Ukwa says, when Oyibo man do he own, then go send a good star. When countryman do he own, then go the shout, kill him, knock him, die. So this is a good style. This is good style.
African man, oh.
Yeah, no. Oh my gosh.
Pardon? What did you say, Des? All right. So I ran this illustration so that there are some things we're going to come back to and try to bring understanding to what we are doing. All right. So policy replacement, let's see. We had gone further than this. We're going to provisions, misstatement of age, representations. We've done credit life, amount of coverage. Remember, for credit life, the most efficient policy type of policy to use is term. The most cost-effective policy to use for credit life is term. You might see that in the exam. Why term? Because it's cheaper. And usually when you take a loan, that loan will last just a certain duration of time. So, credit life. If you have any questions, always interrupt me and ask. Graded death benefits, all right. So I just wanted to run that before we get to the chapter quiz, because we might need to go demonstrate certain things to bring clarity. All right, let's launch. All right. Question 1 of 15. Oluwatosin, can you read this one?
Okay. Which rule would apply if agent knows an applicant is going to cash in and hold policy and use the funds to purchase the insurance? Reinstatement rule, B, replacement rule, C, disclosure rule, D, conversion rule.
Okay.
Sure.
Which rule would apply?
Conversion.
Conversion or replacement?
Replacements, I think.
Okay.
Because
So if they were going to cash in an old policy and use the funds to purchase a new insurance, that would be replacement.
replacement, yeah.
And to the best of my knowledge or guesstimation, that would be the replacement rule. So let's see if, you know. All right. Yes. So, Mr. Oluwatosin, you want to read that? Read that.
Yes, sir. Anytime a new policy is issued that replaces or modifies existing insurance, a replacement form must be submitted to the ceding company.
All right. All right. Next one. Geraldine, you want to read this one?
Sure. No insurance policy form can be issued, delivered, or used in this state unless it has been A, approved by the Department of Insurance, B, filled with and approved by the guaranteed association, C, reviewed by the department and approved by the governor, D, developed by the director.
Okay. So which one do we think is the answer? By the way, Dr. Omotola, welcome to class. Dr. Omotola, welcome to class.
Thank you.
And Dr. Omotola is one of the instructors of this class. She's going to be helping us more and more into the future. So we are very blessed, very honored, and very privileged to have her. So, and again, it's a great recruiting tool that somebody as intelligent and as gifted as her is going to be helping to license the people that you guys are going to be bringing in. So we're blessed. All right. So which one do we think is the answer here?
I want to go with A.
A, approved by
Okay.
the Department of Insurance.
All right. Yeah, so A is the most appealing answer here, because we look at D, developed by the director. The director of insurance does not develop policies. C says reviewed by the department and approved by the governor. I mean, that's way up there. The governor is not going to be approving policies. It's a filed with and approved by the Guarantee Association. Again, that's a trick. The Guarantee Association does not exist to approve policies. It exists basically to come in and bail insurance companies that are going through, that are having some financial trouble. So approved by the department is the most likely answer here. Let's see if we're right. And we're right. So you want to read that? You want to read that explanation?
Prior to the use of any policy or contract form, rider or endorsement, insurers must submit the form and all changes to the Department of Insurance and have the forms approved by the director.
Okay. So there's something very pertinent here for you guys to understand that might come in the exam. The director has to approve these forms before insurance companies use them. And if there are going to be changes made, the director or the insurance department has to approve them. So key in on that. All right. Next question. Ms. Ebukon Noloa, can you read this for us?
Yes. During replacement of life insurance, a replacing insurer must do which of the following? Send a copy of the notice regarding replacement to the Department of Insurance. B, guarantee a replacement for each existing policy. C, obtain a list of all life insurance policies that will be replaced. And D, designate a new producer for a replaced policy.
Okay.
I think it's
Okay.
A.
Okay.
It's not like designate a new producer for this policy. Yeah.
A replacing insurer must do which of the following? Send a copy of the notice of replacement to the Department of Insurance.
I'm thinking A.
Okay, so let's eliminate some answers. D says designate a new producer for a replaced policy.
No.
No. All right. B says guarantee a replacement for each existing policy. Is there any guarantee? No.
No.
So we are left now with A and C. C says obtain a list of all insurance policies that will be replaced.
I'm
A
thinking
says
I saw that
send a
before.
copy. Pardon?
I'm thinking I saw that when I was reading, but I
C, right?
so that's why I'm leaning towards C, but I'm not 100% sure.
C, right?
Yeah, I think I saw it when I was
Yeah,
reading.
and she told us now that you asked
Oh,
them.
you told us, okay.
Now, does the Department of Insurance need to be informed in terms of replacing one person's insurance?
They say a replacing insurer must do which of the following?
Insurer. Oh, okay.
I think this is what I think, okay? I think they do both. I think both are right, both A and C. I think because from experience writing policies, if you're going to be replacing a policy, they always need a list of all the policies that you're going to replace.
Yes.
That is true. You have to put all of that.
Yes.
And also the reason why they need that list is that the insurance company has to send a list to the Department of Insurance of policies that are being replaced. So both are right.
Okay, which one is the one they
So
need?
which one is compulsory? If both are right, then
Yeah,
Department of Insurance is looking more like regulatory. If both are right, so that's the
All right.
most do.
So
But
let's.
like I said,
I'm going to default with C, and then we'll learn.
Yeah, C will be
Okay.
the right one.
Let's go with C, and again it's 50-50 here. So
Okay.
all right.
Yeah.
And that's correct. And I'm going to tell you guys the reason why I went with C, okay, or why I thought we should go with C. It's this phrase here. During replacement of life insurance. So in that phase, when it is being replaced, so during, they must obtain a list of all life insurance policies that will be replaced. Now, sending a copy of notice regarding replacement to the Department of Insurance can happen later.
Yeah.
Okay.
But during that phase of replacement, they have to obtain a list of those insurance policies. So,
okay, on basis of prioritizing at the point of replacement, so the C is the appropriate answer.
correct, correct. Yeah. All right. Next.
if you meet these people that said this question, we'll give them cane. Because they want to
talk about the head.
So
They want you to rack your brain, you know. Yeah. Miss Desmond, can you go ahead and read this one?
The premium for a group life insurance policy was due on March 1st. The policy owner was not able to pay the premium until March 31st. What will happen to the coverage under the policy during the 30 days? During the 30 days, the premium was due but was not paid. A coverage will continue in force. B, the coverage will be limited. C, the coverage will be suspended until the premium is paid. D, the policy will be canceled due to non-payment of premium. I would think A, the coverage will continue in force.
Yes.
Because the 30 days, what would be the rationale?
Grace period.
The grace period, yes, would have been taking place to allow it not to fall out of cancellation.
Okay. Which is very true. Which is very true. Which is very true. But I find this question a little facetious because they are talking about group life insurance policy, and then they are saying the policy owner was not able to pay the premium. Are they talking about the employer? Because the employee is not the policy owner; he just owns a certificate of insurance. So, but again, let's follow their law. Again, that's why I don't know if it's Florence who said we'll cane them if we meet them. You know. So, Miss Florence, I'll happy go to my yard, cut a branch, and give it to you to cane them. You know. So the coverage will continue in force, as Desmond said. Let's see if we are right, and that's correct.
Yeah.
Yes. Desmond, can you read the explanation?
grace period provision in group life policies state that the policyholder are entitled to a grace period of 31 days for the payment of any premium. During that time, the coverage will continue in force.
All right, very true, very true. All right, let's go to the next one. Elizabeth, can you read this one for us?
In order for a life insurance policy with graded death benefits to be issued to an individual over the age of 76, the first year death benefit must be at least what percentage of the total face amount on the policy? A, 50%, B, 100%, C, 75%, D, graded death benefit cannot be issued to someone over the age of 75.
Okay.
What does the word graded death benefit mean?
Okay, I was expecting somebody to ask that question.
Mhm.
And that's why I ran this illustration. And this question is too technical for people who are just starting to go take this exam, all right? So let's go back to this illustration here. So you see, when we were entering the policy design, when we're doing the policy design here, the death benefit option, graded is what we selected. Graded means there's a good balance between the increase in the death benefit and the increase in cash, okay? And I'll explain that a little further. What are the other options that we could have selected? Level, increasing, optimal, switch, and graded. Graded, okay, so let's say, let me just run calculate on it with graded for you to see something, okay? So we run calculate with graded, okay? And we go to the policy figures. Let's do the cover page here. Let's look at how the cash growth happens, okay? Let's look at how the cash growth happens. And you guys are going to learn this, and you're going to be an expert in doing this when you get your license, all right? So, okay, so let's look at this option here. Let's look at this option here. For graded, you can see here that the initial death benefit of this policy, or the face amount, was $1.5 million, okay? $1.5 million, and it's increasing as the years go by. Let's go to, say, year 25 of this policy. Year 25, right here, this individual is now 60. Okay, let's look at the cash that has built in the policy. This is the column for cash. Now they have a cash value of $637,000, and their death benefit is now over $2.1 million, okay? All right, so again, year 25, make a mental note of this. Their cash is $637,000. So let's just make a mental note of this $637,000 at year 25. All right. Let's go back and run it with level. Remember, we ran this with graded, right?
Sure.
So you asked the question on what does graded mean. I really want to have you understand it. So let's say you go run this with level, okay? And that's the only thing we changed. So let's do calculate. Level means your death benefit will not increase. Okay, you'll grow cash in the policy. Let's again go to the cover page. Okay, we scroll down and look at the options here. See, for year one, what is the death benefit?
It's an amount.
How about year 10?
Are you kidding me?
That's what I expected you to say, Desmond. Let's go to year 25.
My, oh my.
What's the death benefit? 1.5. Remember, it was it was 2.1 million. So with level, in this industry, we say level is the devil. Never write somebody a policy with level, because their cash will increase, but they have to take their cash out before they die. Because if they don't take their cash out before they die, if they die without having taken their cash, guess who keeps their cash?
The insurance company.
The insurance company. But look at the justification that they give for level. Remember, it was 637,000, right? Undergraded. For level, your cash is higher. It's 653,000. So 637, 647, that is 10,000. So 10,000 plus another 6,000. So that's 16,000. So for a $16,000 gain in the growth of your cash, you're risking losing your entire cash if you die without taking it out. Is that worth it?
No.
No.
All right. So Desmond, do you now understand the difference between graded and maybe level?
Sure. Thank you very much. I do.
All right. So, and that's why I went and ran that illustration, because I knew that we would need to come to it. So, but again, let's refocus on the question. It says, in order for a life insurance policy with graded death benefits to be issued to an individual over the age 76, the first year death benefit must be at least what percentage of the total face amount of the policy? Now, again, like I said, this question is too complicated for somebody who has not been writing policies. But let's just see what the answer is, and then we'll cram it for the exam.
It's still 100% of that 1.5 million, isn't it?
Okay. Let's see if that's the right answer. This question is very tricky. So let's just answer that, and then we will. Okay. Let's see. It might be 100, it might be 75, it might be 50. Honestly, if I tell you that I know for sure, I would be lying. So let's see. Submit. So you say it's not right. So let's see what the right answer is.
50.
Let's see what the right answer is. It's 50%.
Why?
Why is this so?
That's a very they say in order for life insurance policy with graded death benefit to be issued to an individual over the age of 75, the first year death benefit must be at least. So they are saying that if you are issuing a policy for somebody who is over age 75, the death benefit must be at least, because graded will mean it will gradually increase. And some policies will start with a smaller death benefit and then increase.
Okay.
In the case that I showed you, it's starting with the face value, which is $1.5 million, and then it grows. In some policies, they might say, in exchange of paying a lower premium, the death benefit is going to be lower, but it's going to gradually increase. And this is basically saying that for graded, it has to be at least 50% of what the face value is supposed to be. Does that at least loosely make some sense?
Yes.
Does.
Okay. So let's go to the next one. Let's go to the next one. By the way, before I call your name, Ibukun Nolua, what does Ibukun mean?
It means blessing.
Okay, blessings from God. Blessings from the Lord. Yes. So, all right. It's good to know, Ibukun Nolua. Can you read this one for us?
Yeah. How often must an insurer who delivers variable life insurance policy in Missouri determine any changes in variable death benefits?
How often?
How often?
This is a strange question.
Any changes in variable death benefits?
Annually?
Annually.
I'm thinking annually too.
All right. Let's see if we're right. And that's correct.
All right.
The changes in variable death benefits must be determined at least annually. Now, when it comes to this question, they might ask you this question from another angle, okay? They might ask you this question from another angle. They might ask you they might ask you, what is the variable policies? Remember, variable policies exist in a way in which part of your premium goes to pay for a minimum death benefit, and part of your premiums go into an investment account that you have some say in directing which investment accounts those accounts are. So those accounts are going to fluctuate because they're in the variable sector. They might ask you a question to see if you understand that the minimum death benefit is always going to be constant. And the account is never going to fluctuate to take the minimum below what that death benefit is. So they might test you to see if you understand that. But always remember that that initial death benefit is always going to be the minimum. It can go up because of increase in the market, but it's never going to go beneath that minimum death benefit. So just remember that.
Can I ask a question on a variable
Yes.
annuity, or there's no guarantee, correct?
There is no guarantee.
And the investor bears the burden, not the
company.
Not the company.
Correct. Yeah. So, but again, remember, for a life insurance policy, there's a minimum guarantee that the company guarantees. So you're never going to go below that minimum. Now, for a variable annuity, it might be different because it just depends on what percentage of your money is going into the variable sector. I wouldn't advise anybody to do a variable annuity, because annuities are meant to guarantee a certain amount of money for you at retirement. You don't want to put that money in a variable sector. Okay. So next, Ms. Lola, can you read this one for us?
Which of the following would not be an acceptable interest rate on a policy loan? 10%, sorry, A is 10%, B is 4%, C is 6%, and D is 8%.
Okay.
10% will not be acceptable. The correct percentage here in Washington is 8%.
Correct.
So I don't know.
So which of them would not be an acceptable percentage?
10%. 10%.
Correct. That's true. And again, it's also good to remember that for most states, as it is in Missouri and as it is in the Washington state, the maximum they can charge you on a loan on a policy is 8%.
8%, yeah.
I was under the impression that policy loans are at 0% for IUL. So that's the wrong impression.
That would be nice.
No,
Where is your money?
Good question. Policy loans are not at 0. For the Index Universal Life, the loan is actually at 2.75.
Wow.
So they charge you 2.75 for the loan, but as you pay back into the loan, as you pay back the loan, 2% comes back into your account because it's your money. So 2% comes back into your account. They keep less than 1%, which is 0.0075 for transaction cost.
Yeah, for the cost. Okay.
Transaction cost. So yeah, it's basically 0, but minus 0.0075 where it's just kept for transaction cost. All right. So Elizabeth, you want to read this one for us?
Okay.
That is, where are you?
Elizabeth, are you there?
Yes, I'm here. Which of the following provisions in group life policies prevents the insurer from denying a claim due to statements on the application after a certain period of time?
Okay.
A, incontestability. B, grace period. C, payment of claims. D, waiver of premium. So
Answer
A,
is
I would
incontestability.
say A.
Incontestability.
Correct. Correct. Incontestability. Very true. And again, I just want to seize this opportunity to say something about the waiver of premium. Remember, waiver of premium always goes, there's waiver of premium and there are payer benefit. Those are all riders that will cause the policy owner not to pay on a policy when there's a disability. So waiver of premium is when that policy owner is paying for the policy for a different person, like for a family member, for a wife, or for their children. If that policy member, if the policy owner and payer becomes disabled, then, sorry, is the reverse way. Waiver of premium is policy for the owner when the owner is the insured. If they become disabled and cannot pay, after 6 months, the insurance company will take over. They will still be expected to pay for 6 months. Payer benefit is when the owner is paying a policy for somebody else, for example, for a child or for a wife. If the owner becomes disabled, again, they will still have to continue paying for 6 months. After 6 months, the insurance company will take over. So waiver of premium versus payer benefit. Pay attention. It's a 100% chance you'll see it in the exam. Elizabeth, can you read the explanation of incontestability here again?
Incontestability provision prevents an insurer from denying a claim due to statements in the application after the policy has been in force for a period of 2 years, except for non-payment of premium or fraud.
All right. That's good. That's good. Next question here. Miss Tina, you want to read this one for us?
Okay. What must contain what must contain a notice of the graded death benefit in a life insurance policy with graded death benefits? A, the policy application. B, the policy underwriting explanation. C, the policy's provision section. D, the policy's exclusion section.
Okay. Which one do we think is the answer here?
I'm thinking B. I don't know.
That must contain a notice of
Okay. Do we think this will be contained in the policy exclusion section? I'm just trying to eliminate here.
what must be notice of graded.
Do we think it will be in the policy exclusion section?
I think so.
Is that a yes or a no?
Is a no.
I'll say no. You will know. They will not. Exclusions will not have anything to do with the graded benefit. So we eliminate D. Do we think it will have anything to do with the policy underwriting explanation?
No.
No.
So we eliminate B and D. So we are left now with the policy application and the policy provision section.
Maybe application.
No, it's going to be C.
Contain a notice
Shall
of
be
It's
C.
going to be C. Provisions.
Okay.
life insurance policy with graded.
Okay.
death.
Application is not completed by the
The
applicant.
policy provision section, right?
Okay. So let's go with policy provisions and see.
My
Now
goodness.
we know.
Policy application?
Policy
Ah.
application.
Policy application.
That's
Why?
surprising.
Correct.
But what's policy underwriter explanation? Because I would love my guess.
A policy underwriter, when you submit a policy, they take it to the underwriter, or the underwriter takes over and assesses the policy, assesses your attending physician statement from the doctor, assesses your application, assesses any other information that they get towards making that policy, and then makes a decision on approval or denial, and then gives an explanation of that decision. So that is the policy underwriting explanation. It's done by the underwriter. So
this one is definitely a shock. Policy application.
Now,
the question is, yes, sorry.
Mr. Valentine, on the application, are there several explanations that go on the application? And I know that the entire application is all there is.
All right.
But
so
do they explain these things in the application?
Let me answer that question, okay? And that's why I ran this illustration. All right. So this, when you apply, your illustration becomes part of the application.
Okay.
In fact, if they change something during the underwriting process that affects the illustration, you have to run a new illustration and submit it. And that client has to sign a notice of the change of the illustration.
Correct.
So the illustration will contain a lot of the detail regarding the policy. So if I scroll down here, initial death benefit, all of these riders here, you can see here, account options included, index, S&P will put your money in the balance uncapped, long-term rider cost information, additional policy benefits, terminal illness, overloan protection, critical illness, concierge planning rider, long-term care. And as we scroll down, you'll see all of these explanations, you know. And if we go in deeply, we're going to see graded. What graded is, because we're choosing graded here as an option and all of that. So global index account, where your money is being put. So this is part of your application. And when the client signs this, the client is acknowledging the application. You know, so as you can see here, now you can see here, death benefit option, where this was run for level. So you can see level death benefit is explained here. If we change it, go ahead.
Sorry to interrupt. This is more reason why somebody needs to sit down and take a fine comb, a toothpick and fine comb everything that is in the contract, but we usually don't do that, do we?
Well, sometimes people do, sometimes people don't. But a lot of your edge, usually you have to trust your agent to understand what they are putting in there. Because you are not, even if you are as the client, you're reading it, there are some things you're not going to understand. And that's why I say, for example, I told you that level is the devil. You should never write somebody a policy with level, because it's an inside job that is not good. You know, I left it as graded, as level, but come here, change it to graded, run that. It's going to change the outcome, you know. So just somebody, it's good to go with somebody you trust. And also, you guys are getting your license. Training is going to be very important. The better you understand this, the better you'll be able to explain it to your clients, and the better you'll be able to deliver to them a good policy. So very important. All right. So the policy application must contain a notice of the graded death benefit. Now you see in that whole illustration, it has all of those applications, and that illustration is part of the application. And so yes, it's going to be contained in the policy application.
What the question the question wasn't understandable to me. I don't.
Okay, let's go back to the question, Tina. It says, what must contain a notice of the graded death benefit in a life insurance policy with graded death benefit?
Yes.
So what is it that must contain this notice?
Yeah, I don't know.
And it is the policy application.
Yeah, that's the question. The question wasn't very clear. That's all.
Yes.
I didn't understand.
But maybe it was as clear as mud. Hopefully now it's as clear as water.
Yes, good now.
All right. Okay. So let's proceed with the questions. Let's proceed with the questions. Okay. Oluwatosin, you want to read this one for us?
Life insurers are prohibited from including any of following in advertisement except A, policy appraisals and analysis, B, endorsement by government entities, C, explanations that premiums must be withdrawn, D, I can't say the D.
Can you move it up, please?
Yeah, the D option.
Just a minute, let me scroll that. Okay.
A guarantee of company pennies.
Okay.
I think it's C.
Okay.
I think it's D.
D, a guarantee of company earnings.
It's D.
All right. Yeah,
That's
I think it's D. There's no
Yeah, D.
guarantee of any company earnings or the guarantee that dividends will be paid. So
Yeah.
yeah, so D is the answer here. All right. Submit. Ooh.
Oh.
Let's see.
This is crazy.
Policy appraisals and analysis. Let's go back to that question and read the question. Life insurers are prohibited from including any or except. We didn't.
Okay.
We did not catch the except.
Appraisal and analysis. Oh.
Yeah. So endorsement by government entities, they cannot include. Explanation that premiums may be withdrawn, they cannot include. Guarantee of company earnings, they cannot include. Policy appraisals and analysis, yes, they can include. You see.
Okay, except.
We did not catch the except.
Oh,
Yeah.
sorry.
Yeah, but that's okay.
Prohibited. This word prohibited. That's the thing.
Pardon?
The word is fine. Prohibited.
That's what gave us the right answer.
We already failed three now, so
yeah.
That's okay. We'll stay on top of our game.
Yes.
Yes. All right. Next one.
Who is the owner of a credit life insurance policy? Who is the owner of a credit life insurance policy? A, the beneficiary. B, the creditor. C, the debtor. D, the insurer.
Creditor.
B.
The creditor.
All right.
Yeah.
Very true.
Yeah.
Very true. Desmond made sure we stayed on top of our game.
Yeah, we have to finish this.
Time is going, yeah.
The answer says the creditor is the owner of the owner and the beneficiary of the policy, although the premiums are generally paid by the borrower or the debtor.
All right. Okay. Good knowledge. 12 of 15. Ebukun Nolowa, you want to read this one?
Okay. An insured has a life insurance policy with graded death benefits. In the first year of the policy, the death benefit is less than 50% of the face amount on the policy. What amount must the policy contain in accidental death benefit during the graded death benefit period? What amount must the policy contain in accidental death benefit during the graded death benefit period?
Go ahead and do the answers.
Yeah, the answer, A, there is no requirement. B, half the face amount of the policy. C, the same amount as the general death benefit. And D, full face amount of the policy.
This is a tricky question.
I think there is no requirement. I don't know.
It's a tricky question because they're talking, there's a reason why they put accidental death benefits.
accidental death. Okay, the person got in an accident,
Yes,
but the person already has the policy.
correct.
Is that not a rider? Was it included in the policy?
No, it's not a rider. It's not a rider, but they are making a distinction of that person dying from accident as opposed to that person dying of an illness.
Mm.
So let's just pick one answer and then we'll see if we can understand why they are doing that. Okay.
Pick A.
Well, let's go with D. I'll go with D.
Go first amount of the policy, yes.
B.
Yeah.
And
Correct.
that's correct. All right. I'll explain why I thought it was D. I've never seen this question. The first time I'm seeing it, but I'll explain why I thought it was D. Okay, they say life insurance has an insurer has a life insurance policy with great death benefits. In the first year of the policy, the death benefit is less than 50% of the amount on the policy. What amount must the policy contain in accidental death benefits during the graded death benefit period? All right. So there is which word will I use? There is a deduced meaning here, meaning when you write a policy, let's say the older you are, the lesser your longevity of life, right? So if they are making your death benefit graded, beginning with a smaller amount and growing, they are indirectly thinking, okay, if you have because you're a little bit older, if you have an illness that is going to crop up which they didn't know about, then at least they are also hedging their bets that they're going to pay just 50% of that death benefit. Is that clear?
Mm-hmm.
All right. But can somebody control an accident?
No.
No. And that is why that's why I thought the accidental death benefits during the graded death benefit will still be equal to the face amount.
Yeah.
So they cannot depreciate your death benefit based on an accident.
Yes.
Does that make any sense?
Yeah.
Yes.
Pretty much so.
Yeah.
Mm-hmm.
So Desmond said we should stay on top of our game, and we are making sure we stay on top of our game. Ebuko Nolowa, can you read the explanation for us?
Yes. Life insurance policies with graded death benefit must provide accidental death benefit in an amount of at least the face amount of the policy during the graded death benefit period. This requirement only applies to policies that provide less than 50% of the face amount as a first-year death benefit.
All right. Very, very good. Let's go to 13 or 15. Lola, can you read this one for us?
How long must an insurer maintain advertisements used in the sale of life insurance? A, 5 years, B, 3 years, C, 2 years, D, 6 years. I think it's 5 years. All these numbers are confusing. I guess it's 5.
Any takers?
I haven't seen this question before, so.
5 or 2, I'm not sure.
I think it's either 5 or 3.
I think it's about
3, yeah.
5
5
years,
or
yeah.
3. I don't know. I'm not sure. Maybe 3. 5 or 3.
5 or 3. 5 or 3.
Mm-hmm.
5 or 3. 5 or 3.
So go with the 3B according to.
Oluwatosin, you want to make a pick?
No.
Following your rule, go with B.
Go B, yeah.
All right.
Are you sure?
Mhm.
So you guys put me on the hot seat.
Yes.
Let's experiment.
Let's experiment.
Okay,
Oh,
it was
5.
It was A.
it's a 5.
It's 5.
It's a 5.
It was 5. Yes. I should have gone with Tina. Tina said 5. I should have gone with.
I said 5, but then, like I do, I change my mind.
Yes. So at least we've learned. You know. At least we've learned.
5 years. Mm-hmm.
Correct. Miss Geraldine, can you read this one?
How must a replacing producer respond to an applicant wishing to replace existing life insurance? A, the producer must collect the existing policy and turn them over to the replacing insurer. B, the producer must provide the applicant with a notice regarding replacement. C, the producer has no specific duties. I can see D.
It's right there.
The producer must request the permission of the existing insurer.
All right. So then there's something we want to learn here, and we want to remember that notice regarding replacement is usually sent to the client. So they say, how must a replacing producer respond to an applicant wishing to replace life insurance? The producer must collect the existing policies and turn them over to the replacing. Okay, the producer must collect the existing policies and turn them over to the replacing insurer. The producer must provide the applicant with notice regarding replacement. Yes, they do that. The producer has no specific duties. That's not true. The producer must request the permission of the existing insurer. We have to remember that when they are doing that replacement, when you fill that application, you come to that section, there's a section there that talks about replacement. So you answer all the questions. And that section also goes to the client to sign, because the client has to sign before it goes over to the underwriter. So within that body that it's signed is the notice of replacement. So, and that's why I think that the producer must provide the applicant with notice regarding replacement. So let's see if we are right. And this one that we cram and we remember. And that's correct. Ms. Geraldine, you want to read that explanation?
In replacement transaction, a producer must present to the applicant a notice regarding replacement, signed by both the applicant and the producer.
All right. Good stuff. The last one for tonight, is Miss Tammy there. Is Tammy there? Tammy, if you're there, can you do all the honor of reading the last one? I think she's there.
Yes, I'm here.
All right.
It says, which of the following would be the beneficiary in credit life insurance? A, company. B, borrower. C, creditor. D, insured.
All right.
Which of the following would be the beneficiary?
Creditor C.
Creditor C.
All
Yes,
right.
C.
There we go.
Submit.
Creditor is the answer.
Yeah. What the beneficiary?
Click submit, and that's true.
Yeah.
The creditor is the owner and the beneficiary of a credit life policy. Let's see if we squeaked a pass.
Oh,
Missed 4.
We
and
we
really?
squeaked a pass.
We sneaked past this one.
Yes,
Wow,
because
that's
a
great.
lot of unfamiliar words. Yeah,
Yeah.
I haven't come across these questions before.
Correct. But at least they've helped stimulated our minds.
Yes.
Yes.
Yes. They've helped stimulated our minds.
Wow.
And remember, we have been upgraded to Now we are University of Excellence. So
Yes.
this is going
That's
straight
right.
into the bank of the University of Excellence.
Excellence. Yeah.
So we stop recording right now.